Hey, good morning, traders. BA here, and this Monday morning, February 13th, day before Valentine's Day. And what I would like to do this morning is to provide you with our Friday recap on Monday morning for February 10th. It was for last week, 6 through 10, and this is the recap where I go over the weekly levels that we project on Monday morning. See how the market's fared. So sorry I'm a little bit late putting this out, just a little bit busy, so let's get right to it. Alright, first up is the S&Ps. And you'll notice that S&Ps had a really strong move up last week. It was just a power move. But it wasn't strong enough to trip any of our levels. So the market stayed in between the first levels. And you'll see a little bit later on that that's been the case about 90% of the time. So strong move up in the S&Ps, not expecting that strong of a move up, but we were looking for it to hold right across that resistance level right there. So it blew right through that. It had bounced off a couple of times and then blew right through it Thursday and Friday. So anyway, first levels held in the S&Ps. All right, next up are the ZBs, or the 30-year Treasury Bonds. And what we had happen last week in the Treasury Bonds is a strong move up in the first part of the week while the stock market was kind of soft. And then Thursday and Friday, bond market sold off as the stock market strengthened up. So what we have though is you'll notice here it busted through the our upper level, first level there, went right into what I call the it's really the danger zone if we're playing these weekly projections with options, and hit that level right there and backed immediately off. So we had a little bit of volatility in the bond market. Hey, listen, the bond market's at least exhibiting some form of two-sided action. We can't really say that for the stock market. All right, so that's how we ended up for the week in the bond market. Now crude had the absolute opposite trade. We had a very stiff sell-off, and then it hit that danger zone on the put side that we had projected and rallied straight back up. I mean, 3 powerful days just right off of that level right there. So we still closed in between those first levels, stayed right in between those. All right, the dollar for the week. I know a few of you guys are out there trading the dollar. I'm not sure if you still have your positions on, but we caught a little bit of a bid. It was kind of surprising that we caught a bid in the dollar last week. And going into the week before, since crude had a lot of strength to it, so I was kind of surprised that the dollar went with gold. You'll see that in the chart here in just a minute. But anyway, our levels held. Not that we can play options with the dollar, but anyway, that's just a range of expected price move for the week. And we stayed inside it. All right, here's gold. You can see what I'm talking about. Gold pretty much had a whale of a move up and hit the first level, backed immediately off. So we stayed in between those the first levels and that we had projected for the week in gold as well. I'm really kicking myself because I was long gold right in here and short the dollar. That was the trade of the year. I just couldn't hold it. I came out at my first target on gold when gold poked its head up here to 1160, and excuse me, I closed my position out. That was a really nice trade, but I had another $100 move up in gold. Was it 100? I'm sorry, 90. Had another $90 to go in gold. So anyway, that would have been the trade of the year for me right there. Long gold futures, short the dollar. Perfect timing, just one of the few times you get it right. Don't catch any heat whatsoever. but it was still a nice trade. All right, guys, that's a wrap for our Friday roll up as far as how the price levels went. Now, what I want to show you, let me get over here to find it, is the weekly levels, how well those levels have actually performed in the last 28 weeks of real-time observances. So what I do is I look at level 1 and level 2 that you just saw, and I go back and calculate the stats for how often those markets close inside those first two levels that we track every week. It's really important for option traders to know. It's not enough to know when you put option trades on what those statistics are, but you really want to know how they bear out in real time. And what I'm trying to measure here is I'm trying to get a sense of those first and second levels to see how often those markets that we track actually stay inside those ranges that we project. So that's all this is. So for example, in the ES, we stay in between those first levels 92% of the time. Okay, that's really important, guys, because when we start getting a little bit more volatility after we get that first big spike, that is going to be the level that's going to carry us home. We can sell those levels. It's going to penetrate it on that first move. When we get out of this range right here, it's going to cut through first and second levels like knife through hot butter. After that first level, we get a little bit of juice in the S&Ps, and that first level is going to be the play of the century to take this market back up to new highs. So that's what I'm waiting for. 92% of the time it stays inside those levels, so we should be able to sell puts with impunity, going forward once we get a down move. All right, so you can see ZBs. ZBs are a lot more volatile. So that first level, they close inside the first level 67% of the time. Crude inside the level 71% of the time. The dollar 75, gold 67. So yeah, does gold and the bonds look pretty similar? Yeah, they sure do. Okay, that's the levels. You'll see second level, guys, for all of these markets are in the 90s. If we had a little bit more juice in the markets, yeah, you could really just sell those, mortgage the house, sell those, and you'd make a very good living doing that if you had. Just put several $100,000 to that right there if you had it. Okay, guys, that's the stats. That's the Friday wrap up, and this is BA signing off.